Have you ever noticed how every country has its own money? Like, Thailand has the baht, Japan has the yen, America has the dollar, Vietnam has the dong. But here's the weird part. Nobody ever really explains why. We just accept it as normal. Like, that's just how the world works. But think about it for a second. If you run a business, you don't print your own money. If your city needs more cash, they can't just make more. Even massive corporations like Apple or Google, they can't create their own currency. So why can countries do it? What makes them so special? Here at Simple Money, we've spent years breaking down the financial systems that shape our lives. And today, I'm going to reveal something that changes how you see money forever. Because once you understand why every country prints its own money, you'll never look at your wallet the same way again. Let's be honest, most of us have never really thought about why countries have their own currencies. We grow up seeing different money when we travel. We exchange dollars for euros at the airport. We watch exchange rates on the news. And we just think, well, that's normal. That's how it's always been. But here's what nobody talks about. The decision to print your own money is one of the most powerful economic tools a country has. It's not just tradition. It's not just about national pride or having your president's face on a bill. It's about control. It's about survival. It's about having the ability to steer your economy when things go wrong. Imagine this. You're running a household. Your income is fixed. But suddenly, your expenses double. Rent goes up, food prices spike, your car breaks down. What do? You can't print more money. You have to cut back, or borrow, or find more income. You're stuck with the money you have. Now imagine you could just create more money whenever you needed it. Sounds amazing, right? Sounds like a superpower. But here's the catch. It is a superpower. And like any superpower, it can save you or destroy you depending on how you use it. Let me break down the 5 real reasons why every country wants this power. The first reason is what I call economic steering. Here's what most people don't understand about economies. They're not stable machines that just hum along. They're more like massive ships in constantly changing waters. Sometimes you need to speed up. Sometimes you need to slow down. And sometimes you need to turn completely. When a country prints its own money, it can steer its economy. Let me show you what this looks like. Imagine your country is heading into a recession. Businesses are closing. People are losing jobs. Everyone's scared to spend money. The economy is grinding to a halt. If you have your own currency, here's what you can do. You can lower interest rates. You can print more money and inject it into the economy. You can make borrowing cheaper so businesses expand. You can encourage spending. You're literally steering the ship away from the rocks? But if you don't control your own money, you're at the mercy of whoever does control it. You're a passenger, not the captain. And trust me, nobody wants to be a passenger when the ship is sinking. Think about it this way. During the financial crisis in 2008, the United States printed trillions of dollars. They called it quantitative easing. Sounds fancy, but it's just printing money with extra steps. Did it cause problems? Sure. Did it save the economy from complete collapse? Most economists say yes. The countries that had this power survived. The ones that didn't, they struggled for years. The second reason is what I call the inflation control paradox. Now, this one is fascinating because it sounds backwards at first. You'd think printing money causes inflation, right? More money chasing the same goods means prices go up. That's basic economics. So why would controlling inflation be a reason to print your own money? Here's the thing. When you control your money supply, you can manage inflation. You can increase it when you need to, and decrease it when you need to. Let me explain why this matters. A little bit of inflation is actually good. About 2 to 3% per year is the sweet spot. It encourages people to spend and invest today rather than hoard cash. It helps reduce the real burden of debt over time. It keeps the economy moving. But deflation? When prices fall? That's terrifying for an economy. Because if people think things will be cheaper tomorrow, they stop buying today. And if everyone stops buying, businesses collapse. Jobs disappear. The economy spirals. Countries that print their own money can prevent this death spiral. They can add money to the system. They can create that gentle inflation pressure that keeps everything moving. But here's where it gets interesting. Countries that don't control their own money, they can't do this. They're stuck. If their economy starts deflating, they have no weapons to fight it. Greece learned this the hard way. When their economy crashed in 2010, They couldn't print more euros. They couldn't devalue their currency to become more competitive. They couldn't inflate away their debts. They were locked in a box. And millions of people suffered because of it. The third reason is international trade flexibility. This one is huge, but nobody talks about it in simple terms. Here's what's really happening. When you have your own currency, you have a release valve for your economy. You can adjust your currency's value to match economic reality. Let me paint you a picture. Imagine you're a country that exports a lot of stuff. Maybe you make cars or electronics or coffee. Your economy depends on selling things to other countries. But suddenly, your currency gets really strong. Maybe investors love your country. Maybe interest rates are high. Whatever the reason, your money is now worth more compared to other currencies. Sounds good, right? Your money is strong. You're winning. But here's the problem. Your products just got more expensive for everyone else. That car that cost foreigners $50,000? Now it costs $60,000 because of the exchange rate. Your exports collapse. Your factories close. Unemployment spikes. If you control your own currency, you can let it weaken a bit. You can adjust interest rates. You can intervene in currency markets. You can keep your exports competitive. But if you're using someone else's currency, you're stuck. You just have to watch your economy suffer while you can't do anything about it. China has been playing this game for decades. They've kept their currency weaker than it should be to keep their exports competitive. You can debate whether that's fair, but you can't debate that it's powerful. The fourth reason is what I call debt management power. Now, this one is a bit uncomfortable to talk about, because it reveals something most governments don't want to admit. When you print your own money, you can never technically go bankrupt from debts in that currency. Let me say that again. If your debt is in your own currency, you can always pay it, because you can always print more of your currency. Now, before you think this is a magic solution, hold on. There are massive consequences to just printing money to pay debts. Hello, inflation. Hello, currency collapse. Hello, Zimbabwe and Venezuela. But here's what matters. Having this option, even if you never want to use it, changes everything. It changes how investors see your debt. It changes interest rates. It changes your economic leverage. Compare two countries. Country A borrows money in its own currency. Country B borrows money in dollars. Both have the same size debt. When things go bad, Country A has options. They're painful options. They're options with serious consequences. But they have options. They can inflate away some of the debt. They can devalue their currency. They can print money as a last resort. Country B? They're done. If they can't earn enough dollars to pay their dollar debts, they default. Game over. Their economy collapses. They end up begging the International Monetary Fund for help. This exact scenario has played out dozens of times. Argentina, Russia, Thailand, Indonesia, countries that borrowed in foreign currencies and couldn't pay back. Meanwhile, countries like the United States or Japan can have massive debt levels and investors still buy their bonds. Why? Because everyone knows they can always print more dollars or yen if they absolutely had to. Is it responsible? That's a different question. But it's powerful. The fifth reason is political sovereignty. This is the one that gets to the heart of everything. And it's about more than just economics. It's about power. It's about independence. It's about national identity. When you control your own money, you control your own destiny. You don't need permission from other countries to make economic decisions. You don't need to coordinate with foreign central banks. You don't need to follow someone else's monetary policy. You're economically independent. And for most countries, that's worth almost any cost. Let me show you what happens when you give this up. The countries in Europe that use the euro gave up their individual currencies. Greece, Spain, Italy, Portugal, they all use the same money now. What did they gain? Easier trade, lower transaction costs, a powerful unified currency. That's not nothing. But what did they lose? When Greece's economy collapsed, they couldn't devalue their currency to recover faster. When Italy wanted different interest rates than Germany, too bad. When Spain needed to stimulate their economy differently than France, they couldn't. They lost the ability to steer their own economic ship. They became passengers. And during the European debt crisis, millions of people paid the price. Now, I'm not saying the euro was a bad idea. That's a complex debate with valid arguments on both sides. But I am saying there was a real cost. A cost in economic flexibility, a cost in sovereignty, a cost in the ability to respond to local needs. Most countries look at that trade-off and say, no thanks. We'll keep our own money. We'll keep our own control. But here's what nobody wants to admit. This whole system, this idea that countries can just print money, it only works because of trust. Think about it. Money isn't actually valuable. A dollar bill is just paper. The numbers in your bank account are just data. The only reason any of it works is because we all agree to trust it. We trust that the government won't print so much money that it becomes worthless. We trust that our dollars today will still buy roughly the same amount of stuff tomorrow. We trust that the system won't collapse. And here's the uncomfortable truth. That trust is fragile. It's always one bad decision away from breaking. Every government faces this temptation. Print more money, solve today's problems, deal with the consequences later. And some governments give in to that temptation. Argentina has printed so much money over the decades that nobody trusts their currency anymore. Venezuela printed money to cover government spending and destroyed their economy. Zimbabwe printed money so aggressively that they ended up with $100 trillion bills that couldn't buy a loaf of bread. These aren't ancient stories. This is happening right now. This is the dark side of the power to print money. So why don't all countries spiral into hyperinflation? Why does the system work most of the time? Because most countries have learned the hard way that you can't abuse this power. They've set up central banks that are independent from politicians. They've created rules and norms and institutions that prevent the worst abuses. They've built credibility over decades. But that credibility can be lost in months if a government makes bad enough decisions. Let me tell you about two countries. We'll call them Country A and Country B. Both had economic problems. Both had the power to print their own money. But what they did with that power changed everything. Country A's economy was struggling. Growth was slow. Unemployment was high. The government was facing pressure to do something. So they started printing money. A little at first, then more, then more. They told themselves they were stimulating the economy. They told themselves it was temporary. They told themselves they knew what they were doing. But here's what they didn't realize. Every time they printed more money, they eroded trust a little bit. Investors started worrying. People started converting their savings to foreign currency. Businesses started raising prices in anticipation of inflation. The government's response? Print more money. After all, they needed to cover the budget deficit that was growing because the economy was getting worse. Within 5 years, inflation was running at 50% per year. Within 10 years, the currency had lost 90% of its value. Savings were wiped out. The middle class was destroyed. The economy was in ruins. This isn't a hypothetical. This is Argentina's story. Over and over again through their history. Now let me tell you about Country B. They also had economic problems. They also had to make tough choices. But they did something different. When their economy crashed, they did print more money. They did lower interest rates. They did intervene in markets. But they did it carefully, strategically, with clear goals and clear limits. They communicated every step to the public. They showed their math. They explained their reasoning. They built trust even as they were taking dramatic action. And here's what happened. Their economy recovered. Inflation stayed under control. Their currency remained stable. Trust was maintained. This is roughly what the United States did after 2008, and what many developed countries have done during various crises. The difference wasn't about having the power to print money. Both countries had that. The difference was about how they used that power, about the institutions that constrained it, about the credibility they had built over time. Here's what most people don't realize. The power to print your own money isn't really about the physical act of creating currency. It's not about running printing presses or adding zeros to digital accounts. It's about having the flexibility to respond to economic shocks. It's about having tools in your toolbox when things go wrong. It's about not being locked into someone else's monetary policy that might be wrong for your economy. But with that power comes enormous responsibility. The countries that succeed are the ones that treat this power with respect. That build institutions to prevent abuse. That resist the short-term political temptation to solve every problem by printing more money. The countries that fail are the ones that see money printing as a magic solution, that ignore the long-term consequences, that sacrifice tomorrow's stability for today's political convenience. And here's the thing. You can see which category a country falls into by looking at their inflation history. Countries with stable, low inflation over decades? They've figured out how to use this power responsibly. Countries with wild inflation swings or hyperinflation events? They haven't. It's not about intelligence. It's not about resources. It's about institutions. It's about credibility. It's about trust. So why does every country print its own money? Because the alternative is giving up control of your economic destiny. It's letting other countries or international institutions dictate your monetary policy. It's being unable to respond to crises in the way your specific economy needs. For most countries, that's unacceptable, even with all the risks, even with all the potential for disaster. The power to print your own money is worth having. But the countries that thrive are the ones that understand something crucial. This power is a tool, not a solution. It's a means to an end, not an end in itself. It's something to be used carefully, strategically, and with respect for the consequences. The question isn't whether countries should print their own money. The question is whether they have the institutions, the discipline, and the long-term thinking to do it responsibly. Because in the end, money is trust. And trust, once broken, is almost impossible to rebuild.